Welcome to the Upstream Petroleum Development Economic Model presentation. This is a 20-year business plan forecast that addresses the typical considerations and operating model for an upstream petroleum project. This presentation will address the key rationale for the model, which addresses questions around the value that upstream projects bring, and it is essential to have an understanding of the approach to building project models using the conventional approach, which has yielded just some baseline understanding, but yet leaves a lot of room for understanding of questions that are left still unanswered. Typically, models would address considerations on gross operating cash flows, which addresses the maximum operating cash that will be considered prior to your post or pre economic limits, which also creates an economic shutoff in modeling of projects. It provides an opportunity to assess the licensing within typical 20 years license period to operate an asset, and also provide the basis to address working interest analysis in a case of where you have multiple partners in a project. It provides the carry options where companies can be carried or carry some amount of work program prior to which they can be able to now repay that existing carried interest. And then you can now begin to now discuss around the fiscal considerations. It provides also the basis for abandonment and decommissioning provisions, which is often driven by a flat provisions in an escrow account, or uses the popular UOP approach, which is a unit of production approach, to provide a basis to model provisions that will mirror your provisions on revenue forecasts. And then it also provides analysis on economics and valuations of the project. I'll go straight down to addressing the key content of the model. The model has first addresses some key high level understanding of the project's table of contents, which is presented before you, that addresses the key sections of the model. It goes ahead to provide an executive summary that addresses the model key results, sensitivity analysis and scenario planning, model key inputs that addresses all of the considerations in the model, the operating, the capital, the fiscal, and the result, and summarize cash flow projection results. It provides the basis to address gross operating cash flows on an ELT basis, which is economic limit test basis. And here, it provides a basis to understand the key drivers that provides the operating model within the framework of the allowable limit considerations. And then it provides provisions for abandonment and decommissioning costs. Then it addresses pre and post carry commercial issues. It addresses operation plans on depreciations, and then it make a provision for net working capital calculations that is typical for projects to be able to assess some available cash or operating leverages. And then it goes straight down to provide valuations, which includes typical type valuation structures of the net present values, the internal rate of returns, payback periods, and what have you. The model is often flexible to address year-end and mid-year conventions or valuation approaches. It provides a break-even analysis under the P&L basis, utilizes the unit technical cost breakdown analysis, and finally, it produces charts and check to ensure that the model is working as it should. So we will continue. It provides the basis to understand the project from a point that is bankable by providing a summarized model workflow process. Um, Typically, the model is structured within an admin section where you can make inputs and assumptions, and then it provide the output that is sensitized in the calculation worksheets and provide results after the model has been modeled to show the outputs. It follows the structured approach that is proven globally on a pre-ALT basis and a post-ALT basis. Within the structure of the revenues and the royalties, which is deducted from revenues, the operating costs that includes all the cost consideration of fixed variable costs, licenses costs, um, other fiscal costs like dues and levies, and what have you. And then it has provision for operating costs and your abandonment costs. Then it provided key results that addresses the break-even analysis of the oil and gas prices, point forward and full circle economics of NPVs and IRRs, reserve volumes analysis and net cash flow ratios, discounted and undiscounted payout times, and provide the free cash flows. And provide the basis to assess the reserve volumes that gives indications to the break-even volumes and reserves as the project will become economic or not. Here is a quick breakdown of the model's executive summary that provides flexibilities in all the inputs. So all of the yellow tabs we see on row 9 provide the basis to have sensitivities around the key inputs in the model. So each time the model has a drop box of from asset A to E, that runs the model in a case scenario. It provides again the lifetime value analysis for look ahead within every year. It provides the period to which you can run the model on a license basis. It addresses the model on a unit cost on an income statement basis to address the break-even point. It provides the break-even year, where you can size up the break-even year in the model and assess the income and the break-even prices on a particular year. And then it also assesses the carry forward costs or carry interest within a specified years between 1 to just about 16 years of the project. All of the indications of the prices will typically flow as the model is being sensitized within the input assumptions on yellow. And then you provide a chart, a quick executive summary chart that speaks to economic reserves. It provides a basis for the cash flow projections, net cash flows, full cycle waterfall model, unit cost models, carry analysis on a carry and a prepaid model. It provides the basis to address the unit cost approach on the break-even prices and the prices that also models the project as it shows on screen. It provides model that approaches the year's lifetime value and the model's considerations on the break-even production volumes, unit cost break-even prices, and volume of reserves and revenue projections. It provides a one-stop look ahead on the various cost levers that breaks down the existing oil prices in a unit cost structure to give how the cake is being split within the barrel of oil produced. Put simply, it addresses the different cost buffers that is compiled into the different levers to provide a basis to which the barrels is split within this structured scenario framework. It provides a basis for production delays and impact analysis. This simply means it addresses potential delays if the project is delayed by some years. The model can also address the amount of calculated impact of losses when you have a delay in the schedules. So to between year 0 to 3 years delay in the future, the model can address the impact highlighted in yellow just on the bottom of this section. Now for the inputs, the model has got very dedicated color structures that addresses each of the models that provides a basis to look at what exactly runs in the model's framework. It provides a basis to work out the model drivers, the inputs, the scenarios analysis, the operating cash flow assumptions, the economic results, and it provides a portfolio model that addresses if an asset is to be delayed, or the cost can be shifted, or the production can be delayed on different case scenarios highlighted from field A to field F. It goes ahead to provide a structured basis to work out the capex in phases and also operating costs in phases, and provides a basis to work out the abandonment cost if it's a flat consideration or a into operation approach. And then it provides some returns calculations of inputs to give indications of what to be a working interest, carried interest, and uplift as might be required. Now we go down to the scenario analysis. So this section addresses on a high level how models are more calculated to address a scenario analysis, or often called a sensitivity analysis. It provides the basis of those inputs in a structured format in a well-defined framework within step 1 to 5, where the first you define the variables. The second part is to now set up the considerations that will run the price and all the indications in an NPV type of financial metrics criteria. And then it creates scenarios within the base, low, and high using the data table of Excel. And then it provides the basis to rank the variances of each of the variables and creates very nice tornado charts as you see on the screen. It provides a basis to create the result framework within the scenario and sensitive analysis that shows on the earlier tab within our framework that we call the lifetime value as an output in the model. And the model has sense checks to ensure that all of the costs are modeled correctly, that get the results, and it's okay. Now, it provides a look ahead of the project from production volumes to royalty calculations to well costs, processing costs, ingestion costs, export variable costs, labor costs, and capital costs, and provide the profit before taxes, and then works out in calculation on taxes to arrive at your project free cash flows. It also provides a basis to work out the operating cash flow basis that addresses projects within the framework of reserve productions, and also within the planned gross operating cash flows within the framework of calculating what is a feasible year that the project would provide a basis to work out a good basis for its calculation structure. It provides some adjusted costs as the wells are produced, and also provide a basis for labor costs and typical cost operating models for the project. And then it provides a basis to work out the operating cash flows by looking at the maximum of operating cash flows, and provide a structure to gauge in the year to which you can maximize your cash flows before your economic limits. It provides the basis to work out some commercial type arrangement, which is often called the pre-carry or the carry arrangements, whereby companies can be able to carry a certain amount of costs in the future. In our examples here, the pre-carry cost would look at the project's initial cash flows, and then it works out the post cash basis after the pre-carry basis. So in this case, there are provisions in the summary sheet that addresses each of these scenario considerations, and gives us a basis to ensure that the carry costs are retained within a payment period that can be recovered first before you can now share existing cash flows. On the example here, there is a structured framework that provides this basis on a stepwise tranche-based calculation within every year, and every rate that should be applied on a basis to work out the rate that will be applied on the pre-carry basis. And then the return on investment is modeled out right from the structured tranches on a year-on-year basis. So in example here, we have between 15 to 37% that goes from 2024 to 2020 to 2049, and gives a different earnings on a year-to-year basis. Quite detailed. And then it provides a spectrum of returns on a year-on-year basis from third year to the fifth year. So on the third year to fifth year, create a profile that flows within the IRR spectrum, which is the internal rate of return. On post-carry basis, it also provides some analysis that shows that very clearly, and works that out to provide a very simple data analysis that addresses the post carry, which is typically all costs should have been repaid, and then your post carry always net off with the pre carry. What changes here is the movement of the cash that has been injected and has to be repaid before the project continues. And then it provides a basis to provide a profile for the return IRR, the internal rate of return. And then it provides a chart for the carry analysis profile. And then it models out the depreciations and abandonment for each of these assets that provides the basis that is depreciable or not. It also provides the basis to work out different options of depreciations or using the first oil approach where costs are accumulated to the year which operation starts, or is a straight line approach, which is the conventional approach. It also provides the basis to work out the net working capital basis to provide a structured approach to model out what should be a leverage for the net working capital. And then it begins to close out by providing the basis for financial valuations. So here, there's a plan to assess the project on a free cash flow basis, provide a conventional cash flow basis, net present value, undiscounted cash flows, discounted payback period, maximum exposure, IR point forward, and MPV point forward, and then the UTC. It provides a P&L basis of break-even, the P&L that provides basis to work out break-even. So on the chart you see above, it provides the blue are really the revenues, and the break-even prices are on the bars that goes above it, and the gray color shows the net profit after tax as break-even analysis. And then it also provides a structured approach to work out what is the typical type break-even analysis that is highly flexible, looking at the volumes and sales prices and unit costs, works out the contributing margin ratios, and also provide the break-even prices, and then provide a chart that shows break-even prices, break-even units of volume of productions, and break-even sales. Finally, it brings out an output of charts and schematics with infographics of different consideration on the model, or on the reserve models, on the pre-ALT basis of the analysis. It provides the unit cost analysis, waterfall cash flow profile, and also break-even charts also provided. And finally, it brings about uh, validation checks to ensure that the model is working as it should. And then it's essential to know that all of the checks must be accurate to ensure that the model is accurately modeled correctly. For questions and inquiries on the model, we're happy to get questions and respond to clarifications and areas for amendment and updates. And we hope this has shown the value that we bring in this upstream petroleum economic model. Thank you.